In this lesson, we're going to be learning how to account for a critical expense on the income statement, income tax expense. I'll be honest with you, students hear the word taxes and brace for pain, but here's the secret. This chapter isn't really about tax law. It's about timing. Almost everything we do this week's going to come down to one idea. The income you report to your shareholders and the income you report to the IRS are measured under two different sets of rules. And once you understand why those rules differ, the journal entries practically write themselves. Here's the situation I want you to sit with. A company's income statement says it earned $1 million this year. Its tax return, on the other hand, says it earned $600,000. Nobody's lying, nobody's cheating. Both numbers are exactly right. They're just answers to two different questions. The question for today is, how can that be? And what does the accountant do about it? Your instinct might be that the difference like this means someone is cooking the books. It doesn't. It means one set of rules is trying to measure economic performance and the other set of rules is trying to collect money. Keep that distinction in your head all week. Here's the good news. The reason that there's a difference between book income and taxable income isn't new. In fact, you've probably learned about this difference more than once if you've ever taken an accounting class. It comes down to cash versus accrual accounting. Remember that for financial reporting purposes, we calculate book income or net income on the income statement under accrual accounting. According to GAAP and accrual accounting, companies should be sharing information with the public that's useful for assessing their actual performance. That means we want them to recognize revenue when it's been earned, regardless of whether they've been paid yet. And we want them to tell us exactly how much it cost to earn it by matching expenses to the revenues that they helped produce and estimating things about the future, like bad debts, warranties, useful lives. We're able to present a meaningful picture of performance. Taxable income answers a different question entirely. The tax code isn't trying to measure performance. It's trying to raise revenue fairly and collectively. And that leads the IRS to something much closer to a cash basis. The IRS doesn't want your estimates. It wants objective, verifiable events. It wouldn't feel right if we had to pay the IRS taxes on revenue we haven't even collected yet, would it? And you better believe that the IRS isn't going to allow you to deduct expenses that you haven't actually paid yet. Here's the way I want you to think about the IRS. They run on two common sense rules. Rule 1, the IRS can't possibly tax you on revenue you haven't received in cash yet. Suppose you make a big sale on account in December. GAAP says you earned it, so it's in book income. But you don't have a dime of cash from the customer yet. If the IRS taxed you on it today, you'd have to pay real cash taxes on money you haven't even collected. That's not fair. And frankly, it's not collectible. So the IRS waits for the cash. Rule 2 is the mirror image. The IRS would never let you off the hook on cash you have received. Suppose a customer pays you in advance for services you're going to perform next year. GAAP says you haven't earned it yet. It's unearned revenue, a liability. The IRS does not care whether you've earned it. You have the cash sitting right there in your bank account, and the IRS wants its share now. Cash received is taxable, earned or not. So those two rules, no cash, no tax, cash in hand, tax now, explain almost every difference that we're going to see this week. So where does that leave the accountant? With two different income numbers and therefore two different tax numbers. Book income times the tax rate gives us income tax expense. That expense belongs on the income statement, properly matched to the income that we reported there. Taxable income times the tax rate gives us income tax payable. That's the actual check that we owe the IRS this year. When book and taxable income differ, those two numbers differ, and the journal entry doesn't balance on its own. The account that bridges the gap is a deferred tax account, and it's a balance sheet account that's actually quite similar to a receivable or a payable account, depending on the circumstances. And the math is just the difference between the tax we expensed and the tax we currently owe. It represents a real future amount that we're either going to pay or save. But here's the thing, the difference is only temporary. Eventually, revenues and expenses earned and incurred are the same as cash collected and cash paid. So in the long run, tax expense and tax payable should be identical, with one exception that we'll discuss later. But in the meantime, we have to account for the temporary differences. Two directions, two accounts. Take our December sale and account. Book income is higher than taxable income today because we earned some revenue that we haven't collected yet. But that difference is temporary. Next year, the customer pays, the IRS taxes it, and taxable income catches up. We know taxes are coming on that revenue, we just haven't paid them yet. That's a liability, a deferred tax liability, or DTL. Taxes we will pay in the future on income we've already reported in the books. Now, take the advance payment from the customer. Taxable income is higher than book income today. We paid tax on revenue that we haven't earned yet because we got the cash. Next year, when we earn it in the books, the IRS isn't going to tax it again. We've essentially prepaid the tax, and a prepayment is an asset, a deferred tax asset, or DTA. future tax savings that we've already locked in. Here's a memory hook. Book income higher now means a DTL. You owe the difference later. Taxable income higher now means a DTA. You've prepaid and you'll get the benefit later. Here we have a company that's reported book income of $100,000 and faces a 25% tax rate. Two wrinkles. Book income includes $30,000 billed to a client but not yet collected. The IRS is going to tax that next year when the cash arrives. And Harborview, this company, has also collected a $20,000 advance for work it's going to perform next year, which the IRS taxes now. Let's work through it by starting with book income and figuring out what taxable income is, then building our journal entry. All right, let's start with book income. We have $100,000. And our tax rate is 25%. So if I take book income times 25%, I'm going to get my tax expense. Next, I need to figure out what my taxable income is. So I'm going to start with book income and add or subtract things that may or may not have been collected in cash or paid in cash. So we've been told that book income includes $30,000 that was not yet collected. So we cannot pay, or we do not have to pay taxes on that. So I'm going to subtract that $30,000. And then we also have been told that we've received $20,000 in cash in advance for next year's work, which means we haven't recorded that as revenue in this book income, but we must pay taxes on it. So I'm going to add that $20,000. And that will give me my taxable income, and I can multiply that also by the tax rate of 25%, and I would get my tax payable of $22,500. And now I can build my journal entry. So the first one, the $30,000, that actually creates a DTL. Okay, and if I multiply that by 25%, I'm going to get $7,500, and it's a DTL because I don't have to pay taxes on it now. I have to pay taxes on it in the future when I actually collect the amount. So that's a liability today. And then this one, also multiplying it by 25%, gives me a DTA of $5,000. And it's a DTA, an asset to me, because I'm going to go ahead and pay the taxes on this $20,000. And then in the future, when I actually recognize it in book income, I won't have to. It's an asset that will offset my tax expense in the future. So I'm going to debit tax expense for $25,000, and I'll debit DTA for $5,000, credit DTL for $7,500, and credit taxes payable for $22,500. And that's the journal entry. So book income and taxable income are both honest answers to two different questions. GAAP measures performance on the accrual basis, while the IRS taxes something much closer to cash. The IRS won't tax revenue that you have not collected, and they also won't let you deduct expenses you haven't paid. They won't wait on cash you've collected, earned or not. When the two incomes differ, tax expense and tax payable differ, and deferred tax accounts bridge the gap. Book income higher now creates a DTL, and taxable income higher now creates a DTA. In the next lesson, we're going to build a systematic eye for these items. I'll show you how to look at any transactions and tell immediately whether it pushes book income above or below taxable income, and which deferred tax account that it creates.